Choosing an investment is like choosing how you get to work. You can drive the car yourself, which is an ETF. You can hop on a public bus that follows a set, unchangeable route. That's an index fund. You can even hire a private chauffeur, a mutual fund, to navigate the market for you. Or, if you're playing at the highest level, you can rent a private jet, a hedge fund, to bypass the traffic entirely. But here is the catch that most financial gurus hide from you. The jet costs 100x more to fuel, and the physics of finance prove that the boring bus actually gets to the destination faster 90% of the time. If you've ever felt like the system is rigged to favor the guys in suits while you scramble for scraps, drop the word rigged in the comments right now. Today, we aren't just giving you definitions. We are opening the hood of all four vehicles to see which one is built to make you wealthy, and which one is just a sophisticated trap designed to collect fees. Now, before we look at the costs, we have to clear up the single biggest confusion in investing. Most people think an index fund and an ETF are different things you buy. They aren't. Stick with me, because understanding this one distinction is how you stop being a customer and start being an investor. Think of the index as the GPS route. It's just a list of stocks, like the 500 biggest companies in America. An index fund is simply the vehicle that is legally bound to follow that map. An ETF, exchange-traded fund, and a mutual fund are just two different types of engines. One is a high-speed car you can buy and sell on the stock market every second, the ETF. The other is a heavy-duty bus that only opens its doors once a day after the market closes, the mutual fund. So when someone asks, should I buy an index fund or an ETF, they're actually asking a nonsensical question. It's like asking, should I go to the gym or buy a treadmill? One is the goal, the other is the tool. But here is where it gets dangerous. Even if they follow the exact same map, one of these engines has a massive leak that can drain 30% of your wealth before you ever retire. Let's look at the math of the drag effect. If they're driving the same route, why does one end up further ahead? It's a phenomenon I call the drag effect, where expense ratios act like physical wind resistance on your money. A typical index ETF might charge you 0.03% a year. That's 3 cents for every $100. But a chauffeur, an actively managed mutual fund, often charges 1.5% or more. On paper, 1.5% sounds like a tiny number. But when you apply the law of compounding, that small leak becomes a massive flood. Over a 30-year career, that 1.5% fee doesn't just take 1.5% of your money. Because that money is no longer there to earn interest, it can actually eat up to 30% of your total final wealth. You are effectively working 40 hours a week, but giving 12 of those hours away to a manager who, statistically, is probably underperforming the bus. But the drag effect isn't just about fees. It's about internal mechanics. This next part is the secret reason why wealthy investors are fleeing mutual funds for ETFs. It comes down to liquidity and taxes. An ETF is liquid, meaning you can trade it like a stock at 10:15 a.m. or 2:30 p.m. A mutual fund is a static vehicle. You can only buy or sell at the end of the day. More importantly, mutual funds have a structural flaw. If other passengers on the mutual fund bus decide to get off, the manager has to sell stocks to pay them, triggering a tax bill for everyone left on the bus, even if you never sold a share. ETFs use a science fiction process called in-kind redemptions. They don't sell stocks to pay people out, they swap them. This seals the engine and prevents the tax leak. But if the boring bus is so efficient, why do people still pay for the private jet? Let's look at the hedge fund mirage. Now we have to address the private jet of the investing world, the hedge fund. These are the elite vehicles reserved for the ultra-wealthy. But here is the irony. In the math of the market, the more you pay for exclusivity, the less you often get in returns. While a mutual fund charges you a fee to drive, a hedge fund uses the 2 and 20 rule. They take 2% of your total wealth every year just for showing up, and 20% of your profits. Think about that. If they make you $1 million, they keep $200,000. But if they lose you $1 million, they still keep their 2% management fee. The incentive is rigged. They aren't paid to make you win, they're paid to stay in business. Statistically, once you subtract these vampire fees, the average hedge fund actually underperforms the boring bus, S&P 500, over long horizons. You're paying for a private jet that often flies slower than the public transport. So, which ride is right for your journey? For 99% of people, the index ETF is the undisputed king. It gives you the GPS route of the index, the low cost of the bus, and the tax-sealed engine of the car. Building wealth isn't about finding a secret jet, it's about choosing the most efficient vehicle and staying in your seat. I'm challenging you to audit your own portfolio today. If you're switching to the boring bus to save your future wealth, comment committed below.